The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, the incoming Trump administration may already be sending investors a message. Expect a rough ride for the stock market, because it looks like Trump's market honeymoon may just be over. U.S. markets rallied sharply to close at record highs after Donald Trump won the 2024 U.S. presidential election in a stunning comeback 4 years after being voted out of the White House. But that's already turned sour. More than half of the stock's market's, post-Trump election rally has been erased towards the end of the year. So should investors now ditch the so-called Trump trade in the new year? Well, to find out more, joining me now is Gary Dugan, who's the CEO of the Global CIO Office. Gary, welcome to the show.
Hi there. Hi.
Thank you so much for joining us. Gary, markets had experienced a somewhat uncharacteristic end to the year. How exactly did markets fare at the end of the year, and how's it faring now?
Yeah, all the excitement was really around the election results in the United States and had a strong rally. But once we'd hit that peak within about, 2 weeks of November, it's been very, very quiet. And a lot of focus has been more on the negatives than the positives. So there's a very different tone to the markets at present.
I see. Well, as you mentioned earlier, markets' initial reaction to Trump's re-election to the White House back in November was indeed euphoric. Are we seeing the same now, or have that euphoric sentiment died down entirely?
Oh, almost entirely. I think there's been a real sobering up moment. So when you give people the hope of tax cuts, when you talk about, making America great again, the knee-jerk reaction was that must be good news for the equity market. But the consequences are of a very disruptive global economy. So the issue of tariffs, potential higher inflation in the United States, and also the Fed followed by saying, actually, we're not so sure that all these plans will necessarily be good news for the economy. That's when confidence disappeared, and that's when the market starts to have a setback.
I see. Well, then, Gary, does this signal that the Trump trade or Trump's market honeymoon may just be over? What data points show that the Trump market honeymoon is indeed over?
I think two elements of this. One has been that people's anticipation of growth in the future have really gone nowhere. So whilst he might have talked a good story, he's not convinced too many people at present that we're going to necessarily see a stronger U.S. economy. And secondly, the bond market has got worried about his plans because he appears still to be wanting to spend a great deal of money, causing disruption with trading partners, and he's got the Fed spooked. The Federal Reserve, the monetary policy looks like it's going to be tighter than what we thought. So, lots of headwinds here to a positive view.
I see. So what are markets more focused on now? What are investors more concerned about at the moment?
There's been this global increase in interest rates. It's like newspapers in the UK this morning running stories of a disaster in the economy, the worst since the 1970s. It's really him coming to power has precipitated this greater concern in bond markets, leading to higher interest rates and an expectation that through 2025, we're not going to get the cuts in interest rates that we'd hoped for. And the other element has been this very sharp rally in the dollar, which is not always good news for the global economy, because for companies importing goods in dollars, their inflation goes up. So that creates another headwind for the rest of the world.
I see. So how are investors now reassessing their initial enthusiasm for the so-called Trump trade?
I think there's been a real setback for the Trump trade because the Trump trade was basically giving you the opportunity to say, I might have missed out on the tech, but the old economy is going to do well now because U.S. domestic growth is going to be stronger than what we may have previously anticipated. So people were jumping into, the more domestic stocks. We had a good rally in banks and some of the consumer names. But that is starting to dissipate. We're starting to see that drift off. And unfortunately, the tech industry has got stuck because it hasn't given us any big positive surprises for some weeks.
I see. So then, Gary, I think the million-dollar question here is, should investors then ditch the so-called Trump trade? Can we see any further benefits from the Trump trade at the moment?
Well, listen, when he gets past his inauguration, he's going to try and talk the markets high. So People may anticipate that. So the next 10 days, we could see the markets move higher. But I think a lot of people are concerned at the moment about this global increase in interest rates. That's got not good news for markets. And the one equity market in the world that people worry about, the level of valuations, is the US. So it's the one that could unravel. So to be honest, if you want to buy today or you're investing for the next 3 to 6 months, it may be markets outside of the United States that are more attractive.
I see. When you're saying that markets outside of the U.S. are more attractive, what markets are you referring to?
I think you're sitting in the midst of it. I think Asia, is seeing some good flows of money from the United States. Market. I think there is policy-making flexibility in both Japan, China, in order to kind of give people a positive surprise. So if Mr. Trump wants to cause trouble for countries, I think places like China will stimulate their economies with either cuts in interest rates or government spending. And I think constant and continued corporate restructuring in Japan is still a big positive in the eyes of international investors, and that's still a market that can make progress.
What about when Trump sworn into office later this month? Could the euphoric sentiment post-Trump's victory reignite once again?
I doubt it. I mean, I think he just feels very empowered and just wants to do some extraordinary things. So he may just get lost in his battles with immigration and domestic position than he will be in setting policy up for a good 12 months. At the end of the day, he has to convince the Federal Reserve that he's in control of economic policy and that inflation will remain benign. I'm not sure that the policies in the first 3 months will necessarily talk to that kind of playbook.
I see. So are there any factors that could actually reignite the sentiment then? What are investors eyeing under Trump's administration?
I think the quicker he pivots towards talking about tax cuts and says, within the next 3 months, I'm going to cut your taxes, or I'm going to reinforce the policies we've had before, which need a further line of approval. So if he fast tracks the good news, which is tax cuts, more money in people's pockets, an ability of companies to say, I'm going to increase my spending, or an individual to go out and say, I totally believe in this presidency. I'm going to go and run down my savings and buy things or consume services. That's what the market would respond positively to.
I see. Well, going forward then, Gary, should investors look towards, the bond and currency markets to better gauge how markets are interpreting Trump 2.0 rather than, looking into just merely stock markets?
Absolutely. I mean, if there's just one number you want to look at today, it's not the NASDAQ index, it's not crypto, it's the US 10-year bond yield, which today is close to 4.7%. If we're rising towards 5, equity market's definitely going to be in trouble. If we're peaking out here and start to drift down again, then I think the confidence comes back into equities. And, we have a reporting season coming up where some of these companies are going to talk that their numbers were better than expected and that the outlook for 2025 is positive, and that would help the market to rise. So watch out for that 10-year. Moving towards 5, you've got to be concerned.
I see. And before we let you go here, Gary, what else will you be eyeing in the Trump 2.0 that could shift market sentiment in the next 4 years?
I think it's going to be those tax cuts. We worry about how he's going to fund it, but the initial reaction is, deliver these tax cuts earlier, get people back positive, and then the economy could start to reignite with a surprise to the upside on growth. So that's going to be crucial in these coming months.
I see. Well, thank you so much, Gary, for joining me and your time and your insights today. Thank you
very much.
That was Gary Dugan, who's the CEO of the Global CIO Office. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.